Silver prices on the COMEX exchange experienced a 5.2% intraday decline on Thursday, falling from $91 to $86.24. Market observers characterize the volume signature of that decline as atypical, noting large block sell orders, an absence of bid support, and vertical price action inconsistent with routine market behavior. While North American retail markets responded to the price decline with bearish sentiment, data from Asian exchanges painted a markedly different picture, with institutional traders in Shanghai, Tokyo, and Singapore moving aggressively into precious metals markets during the North American overnight session. The Shanghai Gold Exchange reported physical gold withdrawal requests running at an elevated pace, with figures cited at 473 metric tons processed within an 18-hour window. Separately, the Tokyo Commodity Exchange recorded an expansion in front-month silver contract premiums over spot prices, reaching levels not seen since an April 2025 period, during which the United States Mint suspended Silver Eagle production for 3 weeks. Meanwhile, Shanghai Futures Exchange silver inventory declined by 2,100 metric tons within a single 24-hour period, a figure representing approximately 8% of total global annual silver mine production, which stands at roughly 26,000 metric tons per year. These concurrent data points from multiple Asian exchanges drew attention from market analysts monitoring the divergence between paper-priced silver in Western markets and physical demand activity in Asian trading sessions. The timing of this activity coincides with a reported geopolitical deadline of Sunday, March 1, 2026, tied to a United States presidential ultimatum directed at Iran regarding nuclear enrichment compliance. White House briefing language, as cited in available reports, described the consequences of non-compliance as immediate strategic action. Turning to the specific mechanics of Thursday's COMEX session, the exchange opened and within the first 90 minutes of trading recorded a price movement that took silver from $91 down to $86.24. The decline was described by analysts as a coordinated algorithmic sell-off, with the volume and price action bearing characteristics of institutional rather than retail-driven activity. Mainstream financial outlets including CNBC and Bloomberg attributed the move to profit-taking and pre-weekend de-risking. No reference was made by those outlets to the concurrent physical demand surge observed across Asian exchanges during the same period. As North American traders responded to bearish headlines and social media commentary reflecting concern over the price drop, reports from Asian bullion suppliers indicated a markedly different tone. Tokyo commodity brokers reported that their entire weekend inventory allocation had sold out before European markets closed. Shanghai Gold Exchange withdrawal activity was described as running at a pace not observed since rumors surrounding the Shanghai Accord in 2024. The pattern emerging across these reports pointed to institutional entities treating the Western paper price decline as a purchasing opportunity rather than a signal of deteriorating market conditions. The concept of weekend risk forms a central element of the analytical framework being applied to these developments. Weekend risk refers to the exposure carried by traders and institutions holding positions across a non-trading period during which significant events can occur without the ability to adjust or close those positions. For holders of long physical metal positions, the risk profile over the coming weekend is described as limited, given that physical assets retain value independent of exchange trading hours. For holders of short paper contracts or leveraged derivative positions, however, the calculus is substantially different. A significant geopolitical development occurring between Friday's market close and Monday's open would produce a gap up in prices at the Monday open, with no opportunity to exit positions at intermediate prices. Short positions would face liquidation at whatever price the market opened, with no mechanism for managing the loss during the intervening period. Stepping back to examine the broader monetary context surrounding these market movements, analysts point to an accelerating trend of de-dollarization among BRICS nations, a grouping that includes Brazil, Russia, India, China, and South Africa, along with expanded members including Iran. Reports indicate that Saudi Arabia has moved to accept Chinese yuan as payment for oil transactions, while Russia has been settling energy contracts in rubles and gold. China has been developing a commodities exchange in Shanghai that operates in direct competition with the COMEX and the London Metal Exchange. These arrangements reflect stated official policy positions among participating nations, rather than informal or speculative developments. Against this backdrop, figures related to United States fiscal conditions have drawn scrutiny. The total national debt is reported at $36 trillion, with annual interest expenses on that debt exceeding $1.2 trillion at current interest rate levels of 4.5%. That interest expense is described as surpassing both the defense budget and Social Security outlays in scale. Should interest rates rise to 6%, The projected annual interest burden would climb to $2.1 trillion. The Federal Reserve is reported to have created $16 trillion between March 2020 and December 2025. Data from the Treasury International Capital Report published in January showed that foreign central banks sold a net $83 billion in United States Treasury securities during the fourth quarter of 2025, representing the largest quarterly outflow recorded since the European debt crisis in 2011. The capital rotating out of treasuries has been observed moving into gold, silver, infrastructure investment in developing nations, and bilateral trade agreements structured to operate outside of dollar-denominated systems. On the supply side of the silver market, COMEX registered inventory, the physical metal formerly available for delivery against futures contracts, stands at 130 million ounces. Total open interest across COMEX silver futures contracts represents a notional exposure of over 900 million ounces, producing a leverage ratio of approximately 6.9 to 1. If as little as 15% of outstanding contracts were to stand for physical delivery, the available registered inventory would be insufficient to meet those demands. With a geopolitical deadline approaching over the coming weekend, delivery demand is described as a material risk factor for short position holders. Historical precedent has been cited in this context. Palladium prices moved from $2,000 to $3,000 across 8 trading sessions following Russian sanctions in March 2022. On the London Metal Exchange, a nickel short squeeze in 2022 produced an intraday price spike of 250%, ultimately forcing the exchange to cancel executed trades. These episodes are referenced as documented examples of how supply-constrained physical commodities with high paper leverage can reprice sharply when a forced liquidation event occurs. To summarize the key developments reported across this broadcast, the 5.2% intraday silver price decline on Thursday was accompanied by a significant and simultaneous surge in physical metal demand across Asian exchanges. The Shanghai Gold Exchange reported 473 metric tons of physical gold withdrawal requests within 18 hours. The Shanghai Futures Exchange recorded a drawdown of 2,100 metric tons of silver inventory within 24 hours. The Tokyo Commodity Exchange reported front-month silver contract premiums at their highest levels since the April 2025 suspension of United States Mint silver production. Taken together, these figures from 3 separate Asian exchanges reflect a pattern of accelerated physical accumulation occurring during the North American overnight session. The context surrounding this activity includes the reported United States government deadline of Sunday, March 1, 2026, tied to the Iran nuclear enrichment ultimatum. Market participants holding short paper positions face the weekend risk dynamic described earlier, with no ability to adjust positions should a significant development occur before Monday's market open. The COMEX registered silver inventory of 130 million ounces remains significantly below the 900 million ounces of notional exposure represented by total open interest in silver futures, producing the structural leverage imbalance that observers have identified as a key vulnerability should delivery demands increase in the sessions ahead. London bullion market trading is scheduled to begin at 3 o'clock in the morning Eastern Time, followed by the COMEX Open at 8:30 in the morning Eastern. Those 2 sessions will represent the first opportunity for Western markets to respond to the overnight data outlined in this report. We will continue to monitor developments as they unfold. That concludes this broadcast. Further updates will follow as additional information becomes available.